Hi guys, so in this video I'm going to talk about stock trading and stock market. Basically, how do stock markets function, what are the technical and functional aspects of stock exchanges, who are the key players in the market, how one player can affect other players in the market, how people make money in the market, how people can also lose money in the market. If you are a beginner or aspiring trader or investor, or you are just a normal retail investor who wants to invest in the stock markets to safeguard their money against the rising rates of inflation, I would definitely recommend you to watch this video. But again, if you have been trading in the markets for a while, I would still recommend you to watch this video because I'm gonna teach a lot of important information in it. I mean, give a lot of important information in this particular video, and not just the functional aspects, but all the technical aspects related with it as well. I mean, so the key component of any stock market is the stock exchange. So what is a stock exchange? Stock exchange are the places where the stocks of the public companies are listed and where people can trade their stocks. I mean, by trading, I mean where people can buy and sell stocks of the listed companies. So there are many major stock exchanges worldwide. Like some of the major stock exchanges of India are NSE, National Stock Exchange, BSE, Bombay Stock Exchange, and MCX. And if I show you the websites of these, like this is the website of NSE, this is the website of BSE, and this is the website of MCX. Similarly, there are many major stock exchanges in United States as well, like NASDAQ is there. Then there is NYSE in United States, which is New York Stock Exchange. There is CME, which is Chicago Mercantile Exchange Group. In Europe also there are many major stock exchanges. One of them is Euronext. There are many crypto exchanges, like Binance is there, one of the major crypto exchanges. Bybit is there, again one of the major crypto exchanges. Okay, now every company which is listed on the stock exchange, they are listed by a unique, or they are identified by a unique symbol name. It is also known as ticker name sometimes. Like here are some of the example ticker names. Like the ticker name for Reliance is Reliance itself. For Adani Enterprise, it is Adani ENT. For State Bank of India, it is SBIN. And similarly, every listed company will have a unique symbol name. This is how you basically identify a particular company. And if one ticker name has been assigned to a particular company, it cannot be assigned to any other firm. And the stock of a particular company can be listed on multiple stock exchanges. Like Reliance is listed on NSE and BSE, right? So again, like United States companies, big tech firms of United States also have unique ticker symbols names. Like for Google, it is GOOGL. For Microsoft, it is MSFT. For Apple, it is AAPL. For Nvidia, it is NVIDIA. I mean, every firm which is listed on the stock market, on the stock exchange, will have a unique symbol name. Now the question is that how do you basically trade? I mean, how do you trade on the exchanges? So there are like two ways. One way is that you can start directly trading on the exchanges itself. I mean, you can take the exchange membership, but the exchange membership is very costly. I mean, most of the people like us cannot afford it. I mean, only large trading firms who have a lot of capital can afford it. Like for example, high frequency trading firms like Tower Research, Graviton, Quadai, they have a lot of capital, so they can easily afford exchange membership. Once they take exchange membership, so they can have like dedicated TCP connections with the exchange servers. They can connect their trading servers to the exchange server. Now exchange also provides the order entry protocols and the market data protocols, so they can implement both of them. They can listen to the market data coming from exchange. Then their market data application can listen those, parse whatever is coming. It can give it to the strategy can identify whether it was a buy or a sell signal, and strategy can accordingly fire an order. Now the order entry application will actually send the buy or sell order to the exchange. So this is how like typical trading companies work. But retail investors like you and me cannot function like this. And just to give you an overview how costly the exchange membership is, so let me show you one of these things. Yeah, so here I am on the NSE website, and I'm in the become a member tab. Okay, so to becoming a member, like there are two things. You need to have certain deposit and your net worth requirements, and there are some fees and charges. So like if you see here, the admission fees or the application fees itself is 5 lakhs plus applicable taxes. Okay, but this is just the application fees. I mean, you can imagine it like the fees for applying to become a member. There are certain requirements which you need to meet to become a member, and those are like deposits and net worth requirements. So NSE has like different market segments, like capital market segment, which is CM, futures and option market segments, which is FO, currency derivative segment, which is CD. Then there is commodity derivative segment, which is CD, and COM, and debt segment. Okay, So what each of these segment mean that in capital market segment there will be equities trading, futures and option segment is for derivatives trading, like you can buy and sell futures and options here. Currency derivatives are for currency trading. Commodity derivatives are for trading commodities like gold. Okay, and there are like different types of memberships which you can see in this particular column, types of membership, TM, TM and SCM, TM and CM similarly. So you can see below what each of these mean, like TM means trading membership, TM and SCM means trading and self-clearing membership, and so on. Now if you see the different columns listed here, you can see that the rupees, the numbers listed here are in lakhs. Okay, so you can see here itself, like for becoming a TM, that is trading for having a trading membership, you need to have like 85 lakhs of cash, which is required for NSE. And here is the net worth which you need to possess. Like there is some formula by which they calculate the net worth, and your net worth should be at least 75 lakhs. Okay, for they are like for other types of membership, like your net worth should be 100 lakhs, that is what, 1 crore. Here it is 300 lakhs, like 3 crore. This is also 3 crore if you want to become a PCM, if you want to have a PCM type of membership. If you see here in currency derivative segment, like you need 1000 lakhs, I mean it's 10 crores. So you can yourself imagine how costly these memberships are, like 10 crore, 5 crore, 10 crore, right? So people like you and me cannot afford this. I mean, it is very costly. Only big trading firms can do this. So how do we trade on exchanges? So there is where stock brokers come into the picture. So stock brokers are like middlemen between you and the exchange. Like you can sign up on a stock broker website. I mean, you can create your account and you can buy and sell stocks there. And stock broker will then communicate with exchange on your behalf and basically do all the trading and settlements. So some of the major stockbrokers in India are Zerodha, Sharekhan, Upstocks, and stockbrokers only charge a very nominal fees. I mean, as compared to the exchange membership, the fees which they charge is very, very nominal, and in some cases they also do not charge fees. Okay, so I have mostly used Zerodha and Sharekhan, but I think you can use any of the stockbroker which you like. The only requirement is for creating an account on stockbroker, you need to have some valid government ID proofs, and you can just then create your account there. They will verify your identity and you can start trading. Okay, now the thing is, how do people make money in the stock market? So there are various ways. Like one way is that by taking long position in the market. So what do I mean by that? So one way to make money in the market is that maybe you see some stock, you do some analysis on it, and you think that okay, its price is going to rise in the future. So what you can do, you decide that okay, I'm going to buy a Q quantity of shares at price P1 today, and let's say after some time its price becomes P2. So you sell all the quantity which you have bought. So like assuming P1 was less than P2, that is the price at which you sold was greater than the price at which you bought, your revenue will be P2 minus P1 into Q. That is the price difference multiplied by how much quantity you have bought. And your profit will be this revenue minus whatever fees is charged by a stockbroker. And they are like different, you can say like different orgs or different bodies which come into the picture who charge fees. I mean, some fees will be charged by your stockbroker, some fees will be charged by SEBI, SEBI, some fees will be charged by your depository participants. I mean, in case you do not understand all these things, I will explain them in some future videos, but those are the fees applicable whenever you do any kind of trading. And then there are taxes. Okay, so most people like think that okay, I bought at some lower price, I sold at some higher price, so that P2 minus P1 into Q will be my total profit. No, it's not your profit. Your profit will be, that is only your revenue. Your profit will be whatever charges and taxes are subtract. I mean, whatever is left from revenue when you subtract those charges and taxes, when you deduct those charges and taxes. Okay. The other position is that other way is that you take short position in the market. So what do I mean by taking short position in the market is that let's say that today you think that Apple shares are going to fall, like the share price of Apple is going to fall in the future, but you do not have any Apple shares. So there is a concept of short selling in the stock market, and every stock exchange or every broker might not support this. I mean, short selling might not be supported, but the places or the brokers or the exchanges where this is supported, what you can do is that you do not have any Apple shares, but you sell some Q quantity of shares at price P1. Okay, now you did not have these shares, but you still sold it. So it's like you took a loan from your broker and you did not have anything, but you have sold it. So what has happened that you have taken in a way you have taken some loan from your broker. I mean, you took some Q quantity of shares as a loan from your broker and you sold at whatever price was at whatever price it was currently trading. Let's say that price was P1. Now since you have taken that the loan from your broker, like Q quantity of shares you have taken as a loan from your broker, you need to return them to the broker as well, right? So let's say after some time the prices of the Apple fall. Let's say the new price is P2 and P2 is less than P1. What you can do is that you can buy that Q quantity of shares now at price P2 and you can give those shares to your broker. Okay, so your loan with broker is settled. So but you made some profit here. So what is the profit you made here? The profit you made here is this, that you had sold at some higher price which is P1 but bought at some lower price which is P2. Okay, so your revenue will be P1 minus P2 multiplied by whatever quantity of shares you have bought and sold, that is Q. Okay, and your profit will be this revenue minus again the taxes and fees, whatever taxes and fees are deducted on it. So this is how also you can make profit in the market. Like you can imagine that you can also make profit in the market when the stock market is falling. Okay, it's not that you only make profit in the market when stock markets are rising, like when a share of a particular security is rising, it's not share price of a particular share is rising, it's not that you can make profit only that way. You can also make profit when it is falling. Okay, and the way to do that is by short selling. There is a third way also by which people make money, and it is dividends. So what are dividends? So what happens that a lot of companies share, like let's say in 1 year whatever earnings the company's made or whatever profits the company made, what they do is that they share that profit with their shareholders, with all their shareholders. So like some companies give dividends half yearly, some companies give dividends thrice a year or 4 times a year, or some companies only give dividend once a year. Okay, so what happens is that the committee of that particular company will decide that okay, whatever profit we have made, this percentage of that profit we are going to give as dividends. So every shareholder gets that amount. So this is also a very good way of making money. I mean, if I give you an example, so what had happened is that there is this share of PSU, which is Steel Authority of India. It is listed as the name of SAIL, like the ticker name which I told earlier. It is listed as by the ticker name of SAIL on NSE and BSE. So if you see here, like I had some shares of it, and if you see here, in between 2021 and 2022 they have given these 4 dividends. Okay, so if you see the dividend in rupees, it is this, like they gave 1.8, then 4 rupees, then 2.5 rupees, then again 2.25 rupees. So in just a span of 1 year, how much dividend they have given, if you add it, it comes out to be 4 plus 2 6 plus 2 8 plus 1 9, and if you add this 80 paisa, 50 paisa and 25 paise, it would come out to be like around 10 rupees, 10 or 11 rupees. Okay, so per share, like this 10 rupees is given per share. So let's say if I was holding 10,000 shares, if I had 10,000 shares of SAIL, how much I got as a dividend? 10,000 into 10, which is 1 lakh rupees I got as dividend only in 1 year. Let's say some big investor, he might be holding 1 lakh quantity of shares. Okay, 1 lakh units of share. So what is the dividend he got? 1 lakh into 10, that is 10 lakhs. So this is also a very good way of making money. I mean, I try to always buy the shares which give dividend. I mean, it's not that every company gives the dividends, like companies like Paytm, Zomato, they don't give dividend. So I usually don't recommend people to buy those shares. But again, if you're going to buy a share for very long term, it is always better to buy the shares which give dividends. So these are the 3 ways usually how the people make money. Now, whenever you are sending an order to the market, so there are different types of orders, like limit order and market order. So what are both of these? Let's understand. So let's try to first understand what is limit order. So what happens is that whenever a stock is being traded in the market, so what stock exchange does is that they maintain an order book per symbol. So by per symbol, I mean that there will be an order book for Reliance, there will be an order book for Adani Enterprise, there will be an order book for State Bank of India. Okay, like for each stock which is listed on the exchange, there will be a order book for it, and the order book represents like what are the buy and sell prices which people are quoting at that moment for this particular stock. Okay, so this is the buy order book, you can say, and this is the sell order book. So it contains all the orders which of the people who are willing to buy this particular share, and this sell order book contains all the orders of the people who are willing to sell this particular share. Now buy and sell are also known as bid and ask in stock market, and you can sell is also often known as offer. Okay, now how does order book looks like it usually has, it might have some more information, but the important piece of information is this, that how much, that at what particular price, how much quantities people are willing to buy or sell. So this, and buy order book is always sorted in decreasing order of the prices, and sell order book is always sorted in increasing order of the prices. Okay, now like this is the order book. So but this means that at price 99.80, 10 quantity of shares people are willing to buy. At price 99.75, people are willing to buy 50 quantity of shares. At price 99.65, people are willing to buy 5 quantity of shares. Similarly, this sell order book means that at price 100, people are willing to sell 15 quantity of shares. Okay, now if you see this, what does this mean? This means that the seller who wants the minimum price, okay, like the minimum price a seller wants is 100, but the maximum price which a buyer is ready to offer is only 99.8. Now this means that this order will not get filled. These two buy and sell orders will not get filled. In fact, none of the buy and sell orders will ever get filled, because the maximum buy price is less than the minimum sell price. Okay, and this difference is usually called bid ask spread. Now let's say another person came and he said that, okay, I am willing to buy, let's say 20 shares. I'm willing to buy, let's say 20 shares at price, let's say 100. Okay, I'm willing to buy 20 shares at price 100, let's say. So now what would happen is that what stock exchange does is that they will check in the sell order book. They will see if there is anyone who is willing to sell at a price less than equal to 100. So yes, there is this one person. So what will happen? This guy is only willing to sell 15 quantity of shares, right? So the 15 quantity will get filled here. So what will happen? Let's say this person was some P person. So he will get 15 shares. Okay, he will get, this is called like order fill, and this is partial fill only, partial order fill. And I'll explain you why this is partial order fill, because this person P got 15 quantity of shares at price 100. And why he only got 15? He was willing to buy 20, but why did he only get 15? Because the person who is selling wants to only sell 15 quantity. What about the rest of the 5 quantity? So the rest 5 quantity will be listed in the order book. It will be added in the order book. Okay, so this will look something like this, that this will look something like this, that someone is willing to buy 5 quantity of shares at price 100.00. Okay, and this particular order will be removed from the book because this has been filled. So this is how like order books function at the exchange level. This is the limit order book. We call it limit order book because here people are, this was a limit order because the person quoted that I only want to buy at this particular price. Okay, and usually in interviews, usually we ask, it is a very common interview problem in HFTs or even in tech companies, a low level design problem, maybe an algorithmic problem, that you have to implement limit order book. Explain to you how this order book works, and you can think about how you can code it, and you can think about the algorithm for it. The only difference between a limit order and market order is that in this particular order, in this particular system, like person P quoted the price that I only want to buy at this particular price, but in market order, the person, what would happen is that person P will only say that I want to buy quantity, let's say 20. He won't say at what price. Okay, so his order, now the exchange can fill this order at any particular price. Exchange will try to give him the best price, and you can see that the best price here is this. So this person, what would happen, that he will get 15 quantity of shares at price 100, and okay, he will get 15 quantity of shares at price 100. Like the order will be filled like this, and he still has 5 quantity to buy, right? He wanted to buy 20, only 15 has been filled, so the rest 5 quantity he will obtain it at price, what, at price 100.05. okay, and the way this order book will be updated, like sell order book will be updated, this order will be removed and this order will be updated that from 25 quantity has been sold, so now only 15 quantities remaining. So this is how the market order looks like, and this is how it is filled in the market. I think yeah, I hope that I was able to explain limit order and market orders to you. And as I told you, like, this is a very common interview problem to implement the limit order book, and also support both limit and market orders, support how orders are added in the book, support how orders are cancelled or deleted, what happens when an order is filled, what happens when an order is modified. Okay, and also to give you a visual example, like if I show you the order book for some particular stock, like, yeah, so if you see here, this is a typical order book of HDFC Bank. I mean, when HDFC Bank was being traded, so you can see that this is the buy order book, the bid, and this is the sell order book, the offer. They are calling offer it here, and like the sell order book is in red, the buy order book is in blue. Now you can see here that, as I told you, like, buy order book is sorted in decreasing order of prices, like these are the prices, these are the number of orders, this is the quantity. Okay, and sell order book is sorted in increasing order of prices. Okay, you can see that here. And I already explained you how, like, orders will be added and filled here. Now there are some more information which stock exchange gives you along order book. I mean, like, it shows that at what particular price, this open means that at what particular price this, when the market opened, at what particular price this stock was traded. I mean, basically you can imagine it that this was the first price at which the HDFC Bank was traded when market opened. This high represents that till now this has been the highest price at which this stock has been traded today. The low represents that till now this has been the lowest price this stock has been traded today. The close represents that this was the price at which this, I mean, this was the price last at which this was trading at the previous day. Okay, so the last price at which this particular stock traded yesterday is represented by this close price. Okay, now these two are all also very important, like what is lower circuit and upper circuit. So usually if you place an order beyond, which is less than lower circuit or which is greater than upper circuit, like if you quote that I want to buy or sell a particular stock and the price is given as low, if the price is less than lower circuit price or if the price is greater than upper circuit price, that order is automatically rejected. And these circuits are provided, like if the stock price of a particular stock hits the lower circuit or upper circuit, the trading will halt for that particular stock for some time. You can read about this on Investopedia, but this is also very important concept in the stock market. It is usually implemented or usually given as a functionality to safeguard investors against heavy losses. So yeah, this was mostly about orders. And another thing is that, as I told you about when I was telling you about the exchange memberships, I forgot to mention one thing. So when you take an exchange membership, as I told you, like you can also take direct TCP connections with the exchange, and then you can directly do order entry using the software. So how that is done? So every exchange provides an exchange spec. So this is the specification provided by the spec provided by NSE. So it lists everything. Okay, this is the spec by NSE. Like it tells you that how your application should log on to our exchange servers, and after doing log on, like there is a specific set of protocols which you have to follow. You need to first log on. They will tell you how you can log on. Then this is the place, order and trade management, where they tell you how you can basically do order entry. Okay, if we go to the order entry part here, so this will tell you that how you can do order entry. So if you see here, they represent that this is how their order entry request data object looks like. So you can see here that there are some things which it needs to have a message header. It is of struct type. Its size in bytes is 40. So that's why, like mostly companies use C++, because everything is aligned like that only. You can see here that even the order entry spec is listing everything in C++ construct way, that this needs to be a struct. You can also write this in Java, but yeah, C++ is usually convenient, and even the software running on their side is usually C++. Like they tell you that you need to provide a participant type you reserved, and they are telling you what are the data type of each of these and what are the size in bytes for each of these. So whenever like people like me, developers like me, implement the trade servers. So they follow this exchange protocol. We will accordingly create the order struct or order class. We will have all these fields. We'll make sure that whatever exchange is saying, like the bytes and the offset at which those fields are there, we follow those, adhere to those, all those protocols. So these are all listed in the exchange spec. They also provide you like what are the possible set of values for each particular data member. I mean, if you were to implement it as a class, so you can imagine that these particular things are basically the data members of the class. Okay, now what are the other things of interest here? Again, you can read about this NSE, I would say the specification provided by NSE for order entries. Similarly, there is a specification provided by NSE for market data as well. Like here it is telling you that if you, when you are sending an order, it can be a buy or a sell order. How do you indicate that? You can indicate that by setting a value in this buy or sell indicator data member. Okay, and one represents buy. Like if the value present in that particular data member is 1, it will mean for the exchange that it is a buy order. If value present is 2, it will mean for the exchange that it is a sell order. Similarly, you can tell the price in the price data member, you can tell the quantity which you want to buy and all those things. And I would recommend you to study this and maybe even implement this thing. So these are mostly the technicalities related to these stock exchanges. Now, the most important thing is that whenever you are, going to start trading, there are a few things which you should always keep in mind. Like one of them is investing versus trading. So, like usually in my opinion, investing is the thing when you take long positions and your retention period of the stock is usually some, it may be for short term, it may be for mid term, or it may be for long term. I mean, by investing, I mean that you are not doing intraday trading. I mean, if you're doing intraday trading, then people usually refer people like them as traders. And if you are a beginner, I would say that never enter directly into intraday trading. I mean, it is very, very risky. Always try to start with investing. I mean, you invest, you do read about company financials, you study their balance sheets, profit and loss statements, you figure out whether this company, is, if this company stock is going to rise in the future, or this company stock is going to fall in the future. You accordingly take the long or short position and make money instead of doing intraday trading. I mean, intraday trading is very risky. Usually HFTs do that, and it's because they have some of the best traders, engineers, and their mathematical models are very strong. So you need to have a lot of experience to before starting intraday trading. The other thing is that think about when you want to enter the trade and exit the trade. Let's say you bought the share, some particular share today, thinking that its share price is going to rise. Let's say after few months, its share price has, you brought at P1 and now it is trading at price P1 plus 50. So you should always think about that when you want to exit a trade. I mean, let's say if per share you are earning 50 rupees, maybe at that point you want to enter the trade. Like some people usually become very greedy. They think that, okay, this share is going to rise a little more, and then I will sell. So it's usually not good to follow that particular mindset. I mean, you should think that based on your analysis, you should come up with a number that, okay, this stock can go up to this particular price, and when it reaches this price, I will exit this particular trade. Don't be too greedy, or don't go on assuming things that, okay, this stock price is always going to rise, and eventually when it will come at peak, I will sell this stock. I mean, no one can predict what is going to be the peak of a particular stock. The other thing is that think about the retention period of your stock. I mean, you should divide your investment into short-term, mid-term, and long-term investments. By retention period, I mean that for how many days or months or years you're going to hold a particular stock. It is better to always diversify your investment. Like some stocks you only want to hold for a few days, some for a few months, some for maybe 5-10 years. Okay, think about the percentage of profit. As I told you, like do not wait for a particular stock price to go at the peak and you will sell. Or maybe when you are doing short sell, do not wait that, okay, when this particular stock price will be at its least value, then only I will buy and close the trade. Don't do that. According to your analysis, come up with a number that, okay, if I'm making 10% of profit, I will exit the trade, no matter if this stock its price goes 20% or 30% above its price at which I bought it. No, think about that, okay, I want to make 10%. When I'm getting 10%, I'll exit the trade. Or maybe I want, for this particular stock, it has potential to give me 20% of profit. At that moment, exit the trade. Okay. Usually people have fallen prey to not adhering to these kind of things. Think about your loss appetite. I mean, usually some people, I mean, it depends on person to person. Some people can only bear a few thousand rupees of loss. Some people can bear a few lakhs of loss, or some people can even bear losses which can go up to a few crores, right? So think about your loss appetite. I mean, when usually the psychology of money or the stock market is that when people lose money in the stock market, they start to act irrationally, and when you act irrationally, you are not able to take best decisions. And maybe let's say you did some analysis and you thought, let's say there is some stock which is trading at rupees 50 today. You did some analysis and it seems to you that after few years the stock price of this particular stock will be rupees 100 and I can earn 50 rupees per share. Let's say that time duration was 3 years. Maybe you think that after 3 years this stock price is going to become 100 and I can sell at that moment. But after 1.5 years, maybe let's say that stock price you had bought at rupees 50, but now it is trading at rupees 20 per share. You are losing 30 rupees. So usually some people are not able to take losses, or when they see losses or when they see all their portfolio is in red, they start to panic. You might want to close your trade, and after a few years, when eventually the stock price will go to 100, you will regret that, okay, I did not make money, instead I ended up losing money. So believe on your analysis. That is the main thing. You can limit your losses. I mean, usually if you are involved in intraday trading, you should limit your losses. There is a way to limit your losses using stop loss orders. You should study about stop loss orders. Try to hedge your positions. So by hedging, I mean that you can Google about it, but I will try to explain it in some other video as well. I mean, it is not possible to explain it in this video. This will become very large, but the thing is that by hedging, I mean that let's say you thought that some particular stock price is going to rise in the future. You bought some quantity of that particular stock based on that assumption, but some unfortunate thing can also happen. Maybe in the market can crash, or someone maybe that company turned out to be fraud, or someone did some insider trading in that company. Usually when those kind of news are leaked, the stock prices of the company fall drastically. So even your analysis says that you are going to make money. These kind of events which involve people doing wrong things, people of the companies doing wrong things, can bring it down. So what big firms do is that they hedge their positions. By hedging, I mean that they bought the stock, I mean they took long position on the stock, but they will buy a future or option which will be on the opposite end. I mean, if I am going long on the stock, I will go short on the future or option, or if I am going short on the stock, I will go long on the future and option to hedge my positions. Okay, and what this will make sure that if in future the stock prices fall, I can still make profit by selling my future or option, right? So that is what I mean by hedging. You can study about it on Investopedia. Before investing in the market, it's better to study a lot about market. I mean, don't go directly investing in the stocks or shares blindly. Study a lot about markets, understand about the market, understand the technicalities behind it. You should learn how to do company financial statements analysis. I mean, every public company, they publish their earnings, their financial statements like balance sheets, profit and loss statements. You should learn how you can read. You should learn how to read those and do the analysis and predict the future stock prices. I mean, they have actually helped me. Doing good analysis have helped me identify some very good stocks which have been very profitable for me, and I will also show you those things now. And there are some books as well which you can follow. I mean, I can show you some of them, and in a future video I will show you a couple of more books. Like one of the book, a very good book to understand about the stock markets, is this, Trading and Exchanges. So this is that particular book, Trading and Exchanges by Larry Harris. You can follow this. There is another book which explains the psychology of the stock market, which explains the behavioral finance, which is Stocks to Riches by Parag Parikh. Okay, so understanding psychology of markets, psychology of finance is very, very important. I mean, this book will actually explain you a different kind of, like lots of things, like who are the key players in the market, how people create stock market bubble. I mean, they have some real life scenarios or case studies as well, like when the .com bubble bursted and a lot of people lost money at that moment. This book will actually teach you how to safeguard against all of these. This book will actually teach you how you should do the investment in the markets. Beware of scammers, financial influencers and course creators. I mean, usually most of the people, I mean, there are a lot of scammers in the market as well. I mean, a lot of people who are preying on your money, and who basically, you can assume that steal money from you. So they will like say they will publish absurd blogs that okay, this particular stock price is going to rise in the future, this is going to go down in the future, invest in this, invest in that. I mean, it's stupid things without any analysis. Don't go blindly following that. Always remember that how hard you had worked to earn your money which you're going to invest in the market. Do not make stupid decisions and lose that money. Okay. And you should always remember Warren Buffett's quote, which is that be greedy when others are fearful and be fearful when others are greedy. So the thing is that what most people do wrong as an investor is that when the stock markets are rising, they see, oh, that okay, people are making money, let me enter now. Usually when stock markets are rising or are, you know, at very high points, it is not a great time to enter in the market, because like stock is already at its peak or near to peak value. From there usually stocks fall. Okay, so if you enter at that moment, you will definitely lose money. So that is what Warren Buffett meant, that be fearful when others are greedy. I mean, usually people are greedy at that moment only when they see that okay, everything is rising. But when stock markets fall, like when during COVID, when they fall or fell down drastically, or during .com burst when stock markets fell drastically, or you know, recently during Russia-Ukraine war as well, that was not a very drastic fall, but again there were Sensex and Nifty did come down a bit. So those are actually the moments when you should enter in the market. I mean, usually people are fearful at that moment. That is what Warren Buffett says, that be greedy when others are fearful. When you should always try to enter the market when, you know, stock prices are falling, because usually from there there is the point, like that is usually the best moment to enter the market, because from there when the stock prices will rise, you will make a lot of money. Again, you should also identify the reason the stock prices are falling. Maybe the stock prices for a particular company is falling because their debt has risen. I mean, they have a lot of loans or things like that, or someone did a fraud, or maybe some company went bankrupt. I mean, you should first identify why the stock market price of a particular company is falling, and if you see that it is falling due to some of these things, not because of these things, that that company went bankrupt or something, then only you should invest. And that is usually the good point to invest. Again, the book I told you, this Stocks to Riches, will actually explain you those things, and it will explain you in a lot of detail. So yeah, there is this other resource as well, which is Investopedia, which you can refer to. You know, they are like a lot of, to basically understand the terminology of the stock market. Investopedia is one of the great resource. I already taught you about the dividends of the stock. This money control website is there, which you can refer to read the, I mean, usually the company financials are available here, so you can refer money control website to read the company financials. You should learn how to read the company financials. I mean, there are also a few books on it. I will see like how much views I get on this particular video, and if people are interested in it, I will teach these things myself as well, and I'll tell you some resources about this as well. For the other thing which I mentioned, the other point which I mentioned, I also wanted to give you a live example, like beware of scammers, financial influencers and course creators. Usually people say that it is not beneficial to invest in the stocks of PSUs because they do not, I mean, the stock prices of them don't rise. So it is not actually true. Like there has been a recent incident where, let me show you one example. Yeah, so this is a particular PSU stock, which is Rail Vikas Nigam Limited. It is listed as the ticker names of RVNL on stock exchanges. So I had invested some time back in it. Like when I had invested, it was trading at a price of 32 point. I mean, it was trading at this much price only, 30 to 33 rupees. And during Russia-Ukraine war, the stock went further down. Like it was trading around, I think, 26 or 27 rupees. Okay, and just in that 1 year moment, like now the stock is trading as 141 rupees. So let's say if someone had bought at 30 rupees, he bought, let's say, 10,000 shares. So he must have invested what, 3 lakhs in it at that moment. Now that same amount has become 14 lakhs. Okay, so it's just that don't go blindly following random advices, or don't, you know, that PSUs don't, this particular kind of stocks don't give a very good yield, or this particular kind of stocks don't give a very good yield. Rely on your analysis, rely on your, I would say, knowledge. I think that was all I had for this particular video. Thank you guys for watching. Please do not forget to like, subscribe and comment, and I'll see you all next time.